Hey, how's it going, guys? Welcome back to mentfx, and in this video I want to talk a little bit about how you can use trend and actual structure to determine where liquidity points in the market actually are, and how to properly gauge price and create a bias that will help you deliver price and look for actual intraday swings or long-term swings or positional trades to meet those certain areas. So as a lot of you know, when it comes to smart money, it's very hard to determine whether an area in price is either a structural break or is a liquidity grab. Now, the way that I identify the two and look to make a difference between the two is to ask myself where overall price is heading and determine the next logical area to either be a BOS or a liquidity grab. What I mean by this is if we take a look at this price right here, and again, I'm looking at AJ for no specific reason. Only reason I'm looking at AJ here is because that's my name, or that's my nickname at least. So I just felt like it doesn't really matter. The point is this will apply to any market whatsoever. So looking at this, we can all notice that, of course, we've had this relatively large run up, breaking structure, testing intermediary structure, continuing higher, breaking structure, continuing higher, coming down to retest those last demand zones to continue higher. And now is where it gets a little bit interesting. Right after you see this right here created, a lot of people begin to look at this as a potential liquidity grab and look to take this lower and look to sell it. Now, that's not wrong. You are correct, right? If you do look at the open of this supply zone and look at it tapping in right here and then dropping, there are ample opportunities for sells there. However, if you take the extra step of asking yourself and setting out an example of what happened with price, you notice that price took out this high as a form of a continuation of this overall bullish push. So as a result of that, instead of expecting this area to continue pushing lower for no reason other than the fact that this looks like a grab of liquidity, instead you continue to pour out the bias and example of this being a break of structure higher to continue moving higher. And as a result of that expectation, we see price come right down to mitigate the areas in here, which you can go and of course refine. So for instance, and this is never going to be the case, but we'll do it a few times. If this was a demand zone of its own, right? So you can draw out this entire zone because this whole thing is a demand zone. Honestly, this whole thing is a demand zone, right? So all of this in here is mitigation of that demand zone. Right? And you can of course go start to refine that by either looking at the 50%, and already this can be a refined demand zone for yourself right here. Right, just like that, as simple as that, and that's where you're tapping into. Or you can take this the extra step and refine it a little bit more. How do you do that? You go inside of that specific area, you go down to a little bit of a lower time frame, and you ask yourself about how price was delivered to you in this area. As we take a look at it, we notice that as price came into here, it began to break higher and break structure on lower time frames basically extremely heavily, and then broke structures again right here. Now it came back to mitigate some of the areas in here, right? Without mitigating the last area right here, but also leaving behind all this liquidity and the areas available here that acted as potential last down moves before the up move. So you could already take this and refine it all the way to this push. Now, as you do that, you have to recognize that inside of here, there might be actually something else we can use to determine where prices actually want it to come. How do we do that? Well, if we go inside of here now on a 5-minute chart and ask ourselves the exact same question, kind of zoom in a little bit, maybe ask ourselves what exactly occurred here, we notice that as prices broke, they mitigated, broke out, and never really mitigated this area or this area. So at this point, again, you don't want to over refine just to this zone. Now, again, I might be right, and it might be actually this last demand zone right here that got tested, right? So this might actually be your refined zone that was fully tested. But what I would do is I'd probably increase it to this overall area, counting in this wick right here as a potential area. But let's honestly just do this and suppose that this is actually the area we use. Now, again, when you refine something this heavily, the odds of it being tapped go down significantly, right? So if price does come down and doesn't tap it, it's not because you did anything wrong, it's because you over refined a zone, and that's fine, that will happen, right? But let's say this is the zone you refined, right? You'll notice that not always will it be tapped, so maybe it doesn't get tapped here. Let's go find out. Right there you have it. If you over refine a zone, it does not always get tapped. Now, similarly, if we go back to the 15-minute and just take a look at that over-refined zone, and then go back to what we saw here, right, and actually include the wicks like we spoke about earlier, right, something like this, that might actually give us a different story. Yep, and there you have it, right? So including the overall areas that were still kind of left unmitigated allows you to view that refinement a little bit better and gives you a better bias as to where price could tap into. And notice how I didn't over refine, but I also refined to an area that made sense in terms of price delivery to give us options to go higher. Now, the importance in all this is recognizing that as we have these breaks, that's where we're going to expect price to continue to break higher. And as a result, we know that this is a break of structure and not a liquidity grab. Similarly, as price begins to come down and begins to trade higher here and basically makes all this consolidation movement, we know that this consolidation is not for the purpose of distribution. Well, it could be, but it's less likely for the purpose of distribution, but more so for the purpose of reaccumulating orders to continue pushing higher, because we are still in a bullish sentiment, right? Overall, structurally, this is how structure should be used. Now, again, if you've seen my previous videos, you can of course start throwing in certain tools like these and looking at where areas like this will want to hold, or similarly, throwing in new tools like this, right, on the impulses to understand where exactly prices may want to come to fill, such as these lows, and where exactly price want to come to mitigate, such as these higher volume areas like that, right? So again, if you haven't seen the video on volume profile, make sure you watch it. Now, as price, again, breaks higher here, and again, similarly to last time, makes a move just above and then comes back in, even though it looks like a liquidity grab, which I can agree with some of you might be the case. The fact that we are still delivering price higher, holding the lows and keeping them protected every single time we've broken structure, broken structure, broken structure, broken structure, now broken structure, the anticipation should still remain that we want to continue pushing higher. Now, this is where fractal breaks of structure come in handy and where they can also begin to confuse you. Because if you take a look at this price action, there are actually multiple breaks of structure inside of it. What I mean by that is this leg right here pushed up to break structure, and so did this one right here. So these are both structural breaks on a lower time frame. We can view that maybe like on an 8-hour chart. Boom, right? We have structural break higher, structural break higher. Now, what we have to recognize at that specific point is because that occurred, we now have two potential areas where bullishness can continue to move, right? And notice how what I've done is I've laid out the high here as liquidity. Now, even though I might be wrong, and these equal lows right here might be the liquidity, because of the fact that we are moving to break structure higher, the anticipation is that we're going to come and move to break structure higher, because the market is constantly, especially when it's in an upturn, people want it to basically reverse and they want to catch the high before a huge down move occurs. As smart money traders, we don't do that. We follow smart money as they continue to funnel into positions, and we continue funneling into them with them as it moves, with the anticipation that if it ever does begin to break, that's when we can start to switch our bias to go short, and then we can start the big mark down, right? And whether we get in up here as smart money traders or even in here, this RR and the trade percentage that you can make on this move down can be more than any retail trader catches on this entire move down, or on all the trades they've been trying to catch at every single stop in price to go lower, right? Because after all these moves are made, tons of people are looking to funnel into sells, funnel into sells, funnel into sells, equal highs, funnel into more sells, highs, funnel into sells, new high, funnel into sells. Again, I'm not saying that this is not going to come down. It can, but what we have to anticipate when we're seeing bullish structure delivered to us higher is that at every single structural point, we are actually leaving behind liquidity and not an actual smart money reversal, right? The smart money reversal only becomes valid when we begin to break intermediary structure and higher term structure. And most importantly, really, if we are looking at this as a big impulse, to break this low, to see real price delivery that is going to give us new downward pressure. Now, because of fractalness in this market, and because we're breaking this structure here in these candles higher here and higher here, we now have two demand zones that we can actually use to take the market higher from. And again, because these zones are quite large, if you look at the last down move before the up move, or the last down move before the up move, we can make again an attempt of refining that zone as we did here to understand the best basis for formulating potential buys, even if they are short term. That way, even if you catch a buy in here or here, you can still take them to potential profits or get stopped break even, take them to potential profits or even big profits, or get stopped at break even before having a new move that might come higher. So what I mean by that is if we go ahead and take a look at this last down move before the up move, which we'll look at this right here, we can go ahead and try to refine this area again. How do we do that? Well, we drop down to a lower time frame and take a look at what actually occurred when price was down here. So similarly, if we take a look at this, we see that price came down here, began to come off, right? Came to retest some of these zones here, came off, right? Began to break structure, nothing too crazy. And then from here, came down to mitigate the last few orders that were pretty much left in whatever accumulations happened here, right? So again, this is where you can kind of bring out your tool, and you'll notice that if you take the actual impulse, not only did we come to clear the lower area values in these areas to clear all the liquidity and all the imbalance, but we also came to tap into the last area that had any protectable buys set by smart money or anything of that sort that took us higher. So this is the last area that we would potentially actually look for it to continue holding. So that's the refinement that you would have. Now again, due to the fact that you cannot always be sure about refinement, you could increase this to this low, but the overall refinement of this entire push would theoretically be under this low right here, seeing as price did not mitigate this until it continued to break higher. So we could draw that out. And similarly, we could go down to a 5-minute and look a little bit deeper to see if there's anything we might have missed. For the most part, I don't like any of this movement here, except for potentially, as you can see right here, this break of structure higher that occurred right here, right, that never got mitigated at these last lows, leaving behind a tiny bit of imbalance. So it wouldn't be crazy to suppose that both of these areas here can be refined zones that you can look for buys from, right? Now, this means that we've taken this entire zone that itself is about 70, 80 pips and refine them to zones of about 4 pips and about 9 pips, which means that now these two large areas can be used as potential targeting in the future. And if we go back to the daily, get rid of some of this price action and go back and zoom in on this, we can see that the first zone was mitigated here and might have not given you an entry because of the fact that it came lower and then broke higher. But this zone right here, actually, let's see if that actually held it. I'm not sure. I just refined it randomly. But yeah, as you can see, that is where you would potentially have other options to get long, because it's coming to a refined zone that you were expecting it to go bullish from, and now that bullishness can be met with upwards pressure. But what's also interesting about all this is that at the time of when we came to tap this and we went through it, maybe you stayed out of it because you were unsure about this continuing bullish. But as we have lower time frame structural breaks higher, right, so this is a 4-hour structure break I was looking at this week right here, you can again take the last down move before the up move, which again, we'll get rid of this right here, right, which is this move right here pretty much, right? And then we can go inside here to refine what that zone might have been, because this one didn't give us a perfect enough entry, seeing as it took out the low, so we don't really want to use it to get involved. Instead, we go ahead and get deeper on this, and we go to a 15-minute, taking a look at what price did and how it delivered, right? Again, taking a quick look, we had a very large markup, came down to mitigate some of it. Large markup, never really came to mitigate any of the areas here, right? Create a bunch of liquidity here. So the idea would be, if we are to mitigate this zone, now that it's breaking structure, the areas we'd want to see that mitigation happen would be right in here. And that would be your refinement. So again, we're taking a zone that was about 40 to 50 pips and refining that to an area that's about 10 pips, which means we can take sells down into that area because we understand where the last possible mitigation might actually occur. We'll draw that out again. Let's go back to the 4-hour chart. Actually, we'll stay on a low time frame chart. We can exit out of this and we can see how and what price did as it broke that structure and came back down to it. Notice that again, it had accumulations on a lower time frame here. If you're in the mentorship, you know that there are triple M's that you can use to get involved on this entire markup. There's quite a few entries here that you actually see, or the mentfx blocks, or if you're a normal trader, using the last down moves before the up moves, following them across with structural breaks higher, following them with the last moves down before the moves up, and taking those all the way higher to potential supply zones and imbalances resting above here. Now, as you do that and we get up here, we begin to break structure. And as we begin to break the structure, we know that these structural breaks will either A, come to fulfill the imbalances laid out lower, or come to start taking out all this liquidity to do what? Meet the unmitigated area that we also have drawn out here, which means if we do have lower prices and we begin to push lower, any sells that we take in these supply zones, in these supply zones, in these supply zones, in these supply zones, which never get tapped, in these supply zones, can be areas that we take all the way down into these refined zones. Instead of trying to guesswork this entire zone as a demand zone where it's going to come, right? It's much harder to look at this whole thing and just trying to look for buys, 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 without recognizing where you want to look for those buys from. Instead, refining that zone to certain areas in line with what your higher time frame structure is, and understanding how you want to see that structure ran, right? Which from this exact perspective would be to either see prices run to take new highs again at these points here, or again drop lower from these supply zones here into the demand zones to then continue running those structural highs. Because at this specific point, as we're delivering bullish price action, we anticipate that every new high formed actually acts as liquidity instead of a protected smart money high. Until we actually see a proper market shift lower, there's no reason to anticipate otherwise. Because to see a proper market shift means that they have begun to actually distribute or accumulate longs or shorts to continue in a given direction, which you can't miss, because when you see the transfer of the weak to strong hands, it makes itself very, very potent and obvious to you. Just like currently in Bitcoin, if we take a look at this, for the last few days, ever since we saw the breaks here, and most importantly, the breaks here, the sentiment has been to sell off beyond all the sells here and into the moves here. Why? Well, there's a few reasons to do that. One, higher time frame structure is leading us to believe that this is a structural point that prices want to return to. Additionally, if you throw on the volume profile, which we speak about in the previous video, you will also see that the lowest volume area held at these liquidity points and this imbalance is met with a ton of orders that still need to be mitigated and closed out. And where's the most volume that prices can aim for? The demand zones in this area right here, which is why this movement is currently happening. Okay, so as a result of the overall switch in sentiment that is really across multiple structural breaks, right? So we had structure breaks higher, structure breaks higher. This is also resting as liquidity. As this comes down, this is also liquidity, breaks higher. As this comes down, this is still liquidity until we break intermediary lows and long-term lows. And after that is set in motion, we understand that now all of this most likely acts as liquidity. And as price comes back up, we are now not looking at this as liquidity, but we're looking at this as a protected high, which should hold as prices begin to deliver lower. And that's exactly what happens on Bitcoin, and that's why it's been dropping. We've actually predicted this drop ever since this low was made here, and we've been talking about it continuing to go lower. And I actually believe that it will go a little bit lower, but that's just perspective based. So please do not trade under that without doing your own analysis and without taking your own trades. Now, as we can see, as we're again delivering higher, we expect that these areas here will function as areas of liquidity. Now, that's not to say that prices will buy up from this refined zone. It can easily drop lower, taking out the liquidity here, and then continue higher. But we are ready to trade from these zones and from these potential sell zones to continue on an overall push to new liquidity. This is the idea of doing proper top-down on a market from a smart money perspective. Because what we're doing is we're asking ourselves where the orders are on behalf of smart money, how they are taking those orders higher, where they're accumulating these orders, and what is resting as liquidity for those orders to be delivered in profit. And to do that, we need to continue not just breaking highs, but running those highs as multiple levels of liquidity are being built at them. And until we see proper shifts under real structural lows, we cannot anticipate sells. Okay, unless there's a higher time frame reason for a sell. So again, we're refining those areas, and as a result, we get to trade the intraday. Now, if we are trading the intraday of this entire market, right? Let's get rid of some of this stuff. Let's go to the 15-minute. If we are trading the intraday, and we recognize that after this area of price does not hold, or as it begins to break structure lower, we know that we can already sell off into some of these demand zones, or even to the lower refined zones we had, right? So as we are being on an intraday basis, delivered price short through all these areas of breaking structure. And again, if you have not seen this video, please do, because we actually talk a little bit about AJ, I believe. Yeah, so we talk about AJ and how we were delivering price lower and how we anticipated to continue delivering lower, right? And that's what happened around here. So the video was made when price was around, I believe, let me see if I can find it. I believe the video was made when price was around these points here. Yeah, price was around these points here and these points here. And we pretty much anticipated that it was going to continue to drop off to meet lower prices due to the volume profile and due to the fact that we were beginning to shift bearish. And as these bearish shifts occur, we have Again, Wyckoff occurring across all fractals to take you lower. Wyckoff occurring across all fractals to take you lower. Wyckoff occurring across all fractals to take you lower. Wyckoff on very small fractals to take you lower. Wyckoff test to take you lower. Miniature Wyckoff fractals, I probably wouldn't have used this, to take you lower. And so on and so forth, price is delivered to you lower. And where is that price delivered to, or what can you be using as a target or a partial? These zones here. And as those zones are met and we begin to shift lower time frame structure to the top side, right? Recognizing that, again, the reason we're battling at this zone right here is because of this structural play. Now, this short is probably, it was still a fine short, but what it's most likely than not going to do is going to take us into some of the imbalances here and maybe the imbalances here to then continue the bullish sentiment, right, from these zones to take us and begin to run new liquidity highs. Again, under the supposition that because of this break of structure, the next area that actually stands as liquidity is this and not this. Now, even though it's true that both this high and this low are considered liquidity, we need to ask ourselves which liquidity is more likely to be grabbed. And the way that you answer that question is going to be based on the way structurally price is being delivered to you on the time frame you're looking at. So again, if we're on a daily time frame and structure is still bullish, then we anticipate any highs formed to be the liquidity points that price wants to target. Similarly, if we're on a lower time frame and structure is being delivered on multiple sides of the market, the second we see structural breaks lower, we anticipate that the lows, not the highs, are where liquidity rests. So as this break happens and begins to retrace, we know that price is more likely than not aiming for the liquidity here, but aiming for the liquidity here because we're bearish. Price takes it out, begins to move back up. We now have 2 points of liquidity, this point and this point. Similarly, the point of liquidity that we want to focus on would be this lower one, because on a lower time frame basis, our structure is being delivered bearishly, which means that we are distributing positions here to continue on this bearish run into the potential demand zones that rest below that will then more likely than not switch structure. And as structure shifts, the new highs formed become liquidity instead of the lows, and the lows become protected. Protected, protected, liquidity, protected, liquidity, protected, so on and so forth, and delivers price like so. And as price is delivered that way, you have the opportunities to get involved in longs and shorts on both sides of the market with an anticipation of long-term targets as well as short-term targets. And what I mean by that is if you are to find shorts in here, you know that these shorts should only go to really take out these lows and potentially these demand zones, right? Because the higher time frame structure is pushing higher, which means that on a higher time frame basis, this right here is where liquidity lies, which means that yes, you can be part of this short move, but that should only be short term to then meet you at the liquidity higher. And as this is met and price begins to make a retrace, we need to recognize that on a lower time frame, liquidity, 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 but the second it gets into some deeper demand zone levels, this is the protected low, which means the liquidity that rests on a higher time frame structural basis is at the highs here. And that's how you anticipate movements in price, build stories about price, and anticipate certain levels to hold or be ran. And on top of that, when you take a level and make a attempt to actually refine it, as we took with this overall level here, which we could just look for buys in, or we could refine, you have the opportunity to be short on a counter trend ideal into those lower timeframes until you can then begin to have a bullish bias, unless it's taken out. And if it is, then you again understand where you want to aim for. And similarly, just because this is a demand zone does not mean it has to tap right here and go higher. So what we would do is if you'd go inside of this price action and just took a look at it and recognized how price delivered to you with mitigations here and very poor mitigations here and liquidity resting here, right? You recognize that the areas prices would most likely want to aim for is the last down moves before the up moves here. So if we played around with a little bit of the time frames here, we see that the real last down move was pretty much this one right here. And again, just a miniature refinement of this level allows you to, in the cases that price does begin to break lower than this point, allows you to become a part of all of these new liquidity swings to the low, right? Which means that these are protected on a lower time frame, taking them lower, protected, taking them lower, liquidity, protected, lower, right, until we get into here, at which point the second we have an actual shift, the break of structure enlists this as a now protected low, especially since on a higher time frame, we are now seriously protecting a real term low that actually consisted and made this big break here, which means that if this is to be protected, then the next logical place of liquidity to be met would be the liquidity along the lines of the higher time frame structured price delivery. And that's how you anticipate price. Thanks so much for watching, guys, and I'll see you guys in the next video.